traders. Welcome to today's high-powered explainer of the overnight global macro wrap. If you're trying to make sense of all the overnight chop and you need precise tactical levels for major currencies and Indian equities before the bell rings, you are in exactly the right place. So let's get right to work. Let's kick things off with a massive headline. The Bank of Japan stepped in and spent literally billions just to violently yank the yen off its 4-decade lows. Honestly, it was a massive, incredibly expensive band-aid. Because when we actually evaluate the underlying structural fundamentals, those exact same forces are suggesting a potential march right back to the 160 yen per dollar level.
So, what happened overnight? Well, certainty was pretty much non-existent. We saw some cautious optimism as tech steadied and U.S. equities marched higher on the back of AI earnings. But central banks are waking up to a new reality. The Fed held rates, realizing the economy is demanding enormous amounts of capital just to fund AI and government borrowing. Add in a heavily pressured ECB, cooling U.S. inflation, and a contracting Chinese manufacturing sector, and the takeaway here is pretty clear. Global growth is alive, but man, it is walking with a severe limp.
Now, over in the energy markets, geopolitics kept oil sitting on a knife edge. Brent crude is hovering right near $89 a barrel. Diplomatic efforts and postponed strikes in the Middle East definitely bought markets some valuable breathing space. But you know as well as I do, energy reprices fast. This sets a really tense stage for the week ahead, where the spotlight shifts forcefully back to the data. We've got U.S. payrolls, ISM surveys, and a whole barrage of global PMIs coming up that will absolutely dictate the next move.
But let's circle back to Japan for a second, because here is the stark structural reality behind that BoJ intervention. History shows us time and time again that intervention without true conviction won't fix Japan's core weakness. The BoJ's tightening stance is actively raising their debt servicing costs and encouraging massive capital outflows. Unless policymakers address those underlying imbalances, the yen is highly likely to resume its march toward 160 once the initial shock and awe fades out.
Okay, enough macro theory. Let's move to the micro-tactical and actually translate all this noise into your trading playbook for today.
Looking at the technicals, the dollar index confirmed its bearishness on Fed uncertainty and that yen strength we just talked about. This gives us a really clear sell-on-rise structure today. You're going to want to watch for resistance up at 100.25, with support targets down at 99.64 and 98.60. Your primary soft points and catalysts today will be the S&P and ISM PMI numbers. Conversely, Euro USD is setting up nicely as a buy on dips. With German 10-year yields testing 3.2%, look for resistance around 1.1544, especially ahead of today's HCOB Eurozone PMI release. Moving on to the cable, stubborn domestic services inflation actually drove UK 10-year gilts above that psychological 5.06% mark. The play here is to sell below 1.3475 with a stop at 1.3500, tying directly into today's UK S&P PMI data. Meanwhile, USD JPY is a high-conviction sell-on rise below the 157.60 weekly pivot. Look for resistance around 158.35 to 158.93, with support dropping below 157.31 down toward the 156.75 level. And the major soft point you absolutely need to watch here? The U.S. Treasury has explicitly warned banks to stand ready for future intervention, so keep your stops tight. All right, let's pivot locally to India, focusing on USD INR and Nifty technicals. Interestingly, Indian markets quietly but powerfully outperformed the broader global noise yesterday. Both the Sensex and Nifty edged higher, strongly supported by remarkably healthy earnings, persistent foreign inflows, and mid-caps attracting some very aggressive buyers. The rupee actually closed stronger at 95.38 amid broader dollar weakness. So USD INR is now a sell-on rise against the 94.87 weekly pivot. We're looking at support around 95.21 and 94.92, with resistance at 95.43. Fundamentally, this is backed by India's FX reserves hitting a massive 2-month high of $682.3 billion. On the equity side, the Nifty closed at 24,383, which flips it right back into buy-on-dips territory. Driven by those positive earnings and foreign inflows, we've got a clear target of 24,561, provided the market holds above that crucial 24,344 support pivot. So, as we navigate a week heavily driven by massive data drops and unpredictable geopolitical wildcards, just remember this. When certainty is the absolute scarcest asset in the room, flexibility is your most profitable edge. With central bank interventions looming and key PMIs dropping all week, the real question is, are you married to your bias, or are your levels tight enough to adapt instantly? Stay sharp out there and trade well.